Hey everybody, welcome. This is your marathon live stream. You're with the Market Sniper, the Crypto Sniper, and the Reset Sniper. We've got all the way from Mexico City. He's made space for us. Yes, he's the George Clooney of Twit Finance. One of the best man. He made the whiteboard famous. He's literally sold more whiteboards than all the stationary countries in the world. Yes, George, we're glad to have him. George Gammon is back in the house. He is the rebel capitalist, and he's just finished talking on Simon Black's. He's just told me, I love Simon Black. He's solid. He's been in positioned in all the right ways, asking all the right questions for a long time. You are in the right community. George, thank you so much for coming. Welcome.
Thanks for having me. Yeah, super excited to speak to your audience, and it's always great to go live.
The guys love to have you on. They love to have you on. They'd have you on every time. George, yesterday, data. Let's start with the most freshest information. It is the Great Awakening. We'll get to the theme a little bit, but we've asked a couple of people. Just before you, we've had Daniel DiMartino Booth. We've also had Tom Nwango on. The undershoot on the inflation. Your quick first bite of that.
It doesn't surprise me. About 6 months ago, something like that, I was doing live streams and whiteboard videos saying that my base case is that we would have some disinflation in Q4, Q1. And that was just basically the base effects from what the inflation rates, the months that fall off, and the fact that if you look at what caused the inflation in the first place, we're starting to see a little less of that. So, you would see the demand side with the stimulus checks and the PPP and people not having to pay their mortgage and their rent and their student loans. And although we do see the average checking account to this day higher than it was in 2019, I think that purchasing power is rapidly decreasing. We see the savings rate at an all-time low. And then plus 5-6 months ago, I saw the inversion of the 2-year and the 10-year. And, back then everyone was kind of just sweeping it under the rug saying, oh, that's no big deal. Who cares? It's an anomaly. The Fed's manipulating the curve, blah, 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 blah. And then they also said, that doesn't matter. The only thing that matters is the 3-month and the 10-year.
Yeah.
Okay. Well, now we've got a 40 basis point inversion with the 3-month and the 10-year. Now what? So what that means is there is call it 95% probability that either we're in a recession now or we go into a significant, maybe even a global economic recession in 2023. And if we see that, most likely have asset prices come down. And that's an environment where you get enough aggregate demand destruction to result in some disinflation, even though the supply side of the equation is still very tight. Now, that's not to say that I think that the CPI is going to go back down to 2% and stay there for the rest of eternity, like the Fed's dot plot or whatever. It is to say that I think this 2020s will look very similar to the 1940s. My good friend and I, my good friend Lynn Alden, and I have been saying this for, probably, man, it feels like 2 years now, that it's not really the 1970s, that it's probably going to be the 1940s, in which case you had 3 massive spikes of inflation, and you had some price controls in there as well, which I think we'll see. Maybe we can talk about that in a moment. And in 1947, the CPI went up to 19.5%, and then less than 2 years later, it was -2. But then, of course, the government came in with more deficit spending for the Korean War, and we saw that inflation rate go right back up. So I think you're going to see something similar in the 2020s. Now, the way this might play out going into next year is we get some disinflation, like we were saying, because of the demand destruction with the housing market going down, with the stock market going down, which is a huge component of most people's purchasing power, especially in the United States. And then what we see is the government come in and most likely try to, quote unquote, stimulate the economy. I think the Fed will come in. Most people are putting a little bit too much weight, I believe, on the Fed put, because I think the Fed put has kind of expired to a certain degree, where if you look at March of 2020, when we were in the depths of the collapse, really, that quick collapse that we had as a result of the government policies around COVID, or the fears of COVID back then. The Fed had a meeting set up for Wednesday, this particular Wednesday, and they actually had an emergency meeting on Sunday where they came out, they dropped rates. I believe it was from 1% down to 0. They announced basically QE infinity, and they committed up to $1 trillion a day in repo. And the market was down the next day by like 1,500 points. And the market continued to go down until the government came out with the CARES Act. So the government had to come out with fiscal, and that's when the market actually rebounded. Another thing that I would say is a lot of people right now are looking for a Fed pivot. You know, that's what you're hearing because the CPI was on the low side there at 7.7. And so, oh, the Fed's going to pivot. And then you see the Dow up, what, 1,200 points yesterday, the NASDAQ up, I don't know, 5-6%, something like that. And I would just warn those people that if you go back and look at history, go back to the 1970s, every single time the Fed, quote unquote, pivoted, the market went down significantly, even in the 1970s. So usually what happens is the Fed raises rates, but it's kind of like my good buddy Adam Taggart says, it's like the pig and the python, right? There's like this delayed effect where they spike rates up to, let's say, 4%, but you don't really see that play out in its entirety throughout the economy for maybe 6 months, 9 months, maybe even a year. So the Fed just keeps going up until they see inflation start to come back down, or maybe the unemployment rate go up. But at that time, the damage has been done. And then usually, even if they pause as a result of the stock market coming down, you know, if you look at that historically, the market still goes down by another 25-30%. Now I'm just talking about stocks. Now I think we could see the same thing in the housing market, as long as you're looking at real prices. I have a hard time believing that nominal prices are going to go down in the next 2 years by 20%. Now they could, but I think they could go down maybe by 5% per annum. But then when you combine that with a potential spike in the inflation rate, like we saw in the 1947 by 20%, then you combine that 20% with the 5% compounded over 2 years. Now all of a sudden you're down, what, 35% in real terms. Yeah. And which, of course, is what matters to purchasing power. So I think that people should be very, very weary of, on the bullish side, as far as risk on, just because you think the Fed might pivot. Because the reason the Fed is pivoting is most likely something that's going to cause asset prices to come down very, very quickly. And they might even pivot because asset prices are coming down in a disorderly fashion, right? But I think that what that does is that brings on more fiscal, like we were saying before, because I think we've moved from that Fed put to a fiscal put, to a government put. And then that just takes us right back into the, you know, let's say we get some disinflation down to 4 or 5%. That gives them political cover to come in with another CARES Act. And that's when I think they're going to try to issue a central bank digital currency and whatnot to issue the stimulus checks. And then I think it takes us into another wave like the 1940s of consumer price inflation. But this time, I think, especially if you listen to kind of the rumblings that we hear at the World Economic Forum, the UN, the IMF, a lot of these people, these global elite types, are talking about putting a cap on interest rates for central banks. So this Christina gal, I can never remember her last name, with the IMF. God, yeah. She's discussed this at great lengths. Now you have Stephanie Kelton actually talk about this, the MMT gal in the United States. And I think Janet Yellen is very sympathetic, I think, to Stephanie Kelton's views and the views of most of the people in the MMT crowd. And then you also had this gal, Rebecca Greenspan, come out, spelled different than Allen, but I don't know if they're related. But she's with the UN, and she was really echoing the exact same script that this Christina gal was echoing with the IMF, which is, okay, in the future, or they're saying maybe right now, we should have the central banks stop raising interest rates, because why should we look at the Phillips curve, and why should we try to bring inflation down by bringing unemployment up? That's not fair to the average Joe and Jane. So let's just have Jerome Powell stop, as an example, when we start to see an impact on the employment or on the unemployment rate. And then what we'll do if inflation is still high is we'll give people money to afford the higher prices. We'll call them inflation stimmies, ironically enough. And what we'll do is, because we understand that is going to increase aggregate demand, but we are professional economists. And remember, we are PhDs. So like Elizabeth Warren, we have a plan for that, right? I think what they'll do is they'll cap the central bank interest rates or interest rate hikes. They'll come out with stimmies to afford the higher prices, and then they'll do price controls. Just like we saw in the 1940s and the 1970s, where they'll say, oh, all this inflation is just a result of these greedy capitalists and all these corporations, and they're just taking advantage of you and their windfall profits, yada, 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 yada. So we'll just go ahead and we'll solve inflation very, very quickly. We'll just make it illegal for the companies that are providing you with goods and services to raise their prices. And, problem solved. So people have their free money, quote unquote. We solved consumer price inflation, and we don't have interest rate high enough to where it's impacting the unemployment rate. This is their argument, right? But we know what's going to happen with that is sooner or later something's going to break. And we know that if you artificially suppress the price of something, you decrease the supply.
Yeah.
So the supply goes way, way down, and pretty soon you've got to alleviate that pressure. So you got to get rid of the price controls. And when you do, you see the exact same thing we saw, like I said, in the mid 40s, where we had price controls after World War II up until about 1946. And when they lifted those price controls, that's the reason you had that massive spike up to 19.5% in 1947. So I know I'm kind of projecting far out into the future, but
good.
That's kind of my base case. That's how I kind of see this playing out when I look at the probabilities. That said, there are no certainties. Anything can happen. And I think as prudent investors, we just have to look at things in terms of probable outcomes, not certain outcomes.
Of course. And as you've highlighted, I've absolutely scenario cast for price controls because government has to be seen to do something. Right. And of course, that invariably bifurcates the market into an official market at the price control that then becomes undersupplied, that leads to the Bolshevik communist empty shelves, and then a black market where the bottleneck guy is profiteering to a maximum level. It's banditry, basically. It gives a license to whoever ends up controlling the black market into banditry, where they actually have hyperpricing, and you end up having a nothing market that is not price discovery, that only has a minimal amount of contractual obligation supply, and then you have an extreme shortfall market, which has a very high price discovery mechanism, and it's fatal. And we've seen these, and it is how you gravitate towards Bolshevik communism. We have to do the Soviet Union experiment. It seems. It just feels like we got
it. Gives them another reason to ban cash too.
Yeah, it does. It does give us another reason also to potentially expect, if they're going to try cap interest rates. I have this theory. So just going back a couple, because you said a lot of interesting things there. There's quite a bit to unpack. So we've had a slowdown in the inflation. First, one swallow does not a summer make, as well, is what I would hasten to add. Because I think there's a bit of fluff in the initial inflation number when you've been climbing rapidly, especially when the oil was up. You've recently had Biden do a lot of almost what you'd have to describe as manipulation. I've never actually seen in the US so much active use of state assets to manipulate for political gain, short-term political gain, because you've actually drained to a large extent the strategic petrol reserve to lean on the price, which has probably helped bring in a lower number, because energies is everything. It's the Rockefeller tax on all movement and all packaging and everything. So he's maybe manufactured that number a bit. Although I do also think we're having a chronic recession stroke, more severe version thereof, inside a stubbornly high inflation. So hence why we've coined the hyperstagflation phrase, because you're actually having chronic demand destruction on a bigger scale than the 70s inside an environment where you've got super stubborn inflation. It just feels that everyone's being squeezed on both sides. And I wanted to, Britain is kind of a hyper further down the curve version of the States. They had their their debt go bidless. Japan is almost weekly bidless, which is the most extreme version. And they had their crisis and all of that in the UK. And now they had a stimulus, Truss was stimulus, trying to like tax cuts and get it going. There was an element of trying to, stoke demand in whatever, which wasn't entirely wrong. She got thrown out, and now they're saying tax increases. 60 billion they need in tax increases in an environment that everybody's energy has literally quadrupled. Their currency's buying power is reduced immensely, particularly the pound, remember, which has skidded at a great deal. And you've got all of these forces, and now you're getting a tax on top of all these quasi-taxes of inflation, heating, and various other things. And I'm expecting almost, but the Democrats still got a year to go, and the Republicans maybe going to be a bit bolshy with any midterm gains, that you could have a very stale market, and you could even have the possibility of tax increases coming not too far off in the States. Maybe not in the final year before an election in 24, but potentially maybe this year going into 23, or needed shortly after any future election. What's your take on the additional squeeze of heightened taxes on top of all the inflationary effects?
I mean, I think it's possible, especially when you look at the MMT playbook, right? The traditional MMT playbook is you battle inflation by increasing taxes, because that's taking currency units out of the system. Now, I've noticed that recently they've kind of set that aside, and they're trying to look at a more targeted approach, a more central planning, like we were discussing earlier. Yes. But I definitely think that's something to think about, something to be concerned with. I also think that you're going to see an increase in taxes just because of housing prices going up to such a significant degree, to where those appraisers are going to come by, and they're going to say that your house that you bought for 300 grand is now worth $1 million, and you've got to pay the property tax on that.
Yeah.
So, while your house might be going down, you could be paying higher and higher property taxes. So I definitely think that's a reality. I think that you could see higher local and state taxes as well.
Well, you had a state, Daniel DeMartino Booth was telling me there's a state was it Pennsylvania? That went bankrupt, declared its pension just can't meet its pensions and has gone insolvent.
Yeah, I think the Fed's balance sheet might back up those pensions, especially if they're, we saw that in the UK, to your earlier point. So the pension system is so vitally important to the demand side of the equation, especially when you have all these Keynesians at the Federal Reserve. That's what they're hyper focused on, is aggregate demand. So I don't know that the Fed would allow those things to go under. We talked about the Fed put being expired, but that doesn't mean that I don't think the Fed still has a lot of ammunition to backstop credit markets. And right now, I don't know that they're too worried about the equity markets or the real estate markets coming down, as long as it's in an orderly fashion.
Yeah.
But they would be very, very concerned if we went into like a gilt market type scenario, where there's just basically no bid at the long end of the curve. And that's why I think you hear Janet Yellen come out and talking about doing a debt buyback, which is basically a Treasury version of quantitative, or what was it, Operation Twist.
Yeah.
Where they're talking about buying, selling short-term debt, because that's very, very liquid and high demand right now when you look at the delta between the 1 month and reverse repo. And then then they would buy long-term debt, or maybe off the run treasuries that were far more liquid than a corporate bond market. We saw the Fed step in 2020 and backstop the corporate bond market. So I think the credit market is something where they definitely still have the ability to backstop, but I don't know that is risk on for equity markets, right? But then at the end of the day, I mean, they could just buy stocks. I mean, Janet Yellen has talked about that as well. So maybe they do have some tools in their arsenal that they haven't used yet that could result in a risk-on event. Because I guess if they start buying stocks, then those people with all their fresh stimmies are going to go out there and try to front run the Fed.
Yes, I love what you were just saying there, because this was the same that came out of Daniel DiMartino booth. I do feel it's no longer about crypto, equity, and all these other markets. This is a debt-based game. And we are of the view that there's some things that haven't been marked to market in a long, long time and that are very thin on volume, particularly in other nation states. And the debt market, if it was truly re-rated to where there would be active bids, particularly again outside the US, but eventually what's outside the US can come and visit itself. The credit event is the event that is the breakage that they keep tightening into. And that's the one we should all be worried about. And, you know, MOVE versus VIX, they've sometimes diverged quite strongly, and the equity market is seeing optimism. I don't know how this has been framed, as everybody's just interested in the pivot, and the pivot is a good thing. And it's just a case of rinse, repeat. It seems like, and I said the same to the previous guest, that it's a 40-year buy the damn dip meme is actually the investment strategy, and everyone takes it exceedingly seriously, and that's how you're going to play equities. When in actual fact, I don't think there's anything optimistic to come out of this. I think this is far more structurally damaging, and that we have a credit-based event. And on that note, there were the banks a while ago. It's been a while since I last spoke to you, and I mentioned this to both Daniel DiMartino Booth and possibly Tom as well. The amazing thing is HYG has held up relatively well compared to my short on TLT. And Daniel's opinion was, well, the shelf just above junk is now being treated more like what it should be, and there's a real price discovery mechanism going there, while at least junk is labeled for what it is. That's why it's almost, by doing the much higher percentages, is representing. Because I'm not looking for an answer. Why isn't the dirtiest end of the debt market already collapsing? If this is an issue, so I'm asking the question: why is that happening? And that was one of the answers I got. That the shelves just above it is actually being re-rated more closely, even though it hasn't, by our rating agencies that are applying inflation to ratings instead of allowing them to truly slip down. So I'm curious on your take on that. And yeah, maybe let you have a response to that first before I pile in on more things. What's your take?
So if I'm buying junk debt right now, or if I'm buying corporate debt or anything like that, I am buying it with the understanding that the Fed will most likely backstop the market. So I think that there's an implied put right there, which would maybe explain. I mean, you guys know this better than I do, but would maybe explain why there's such a delta between reality and the actual price or interest rate where these things are trading. And another thing that I'd add to maybe a blind spot that most people have is you go back and look at what happened with the gilt market there, another credit market, and you see that the Bank of England had to quickly go from quantitative tightening right back into quantitative easing, just instantly like that.
Yeah.
But I don't think it was just because of the pension funds that had so much exposure to the long end of their curve. I think it was that they had exposure on leverage. Right. So if you have interest rates at 0% for 10, 12 years, and these pension funds have 7% return to make their liabilities, well, how on earth are you going to do that? You got to take on massive amounts of leverage to buy, let's say, a 10-year gilt at at 50 basis points or whatever, or a percent to get that 7% that you need. And then you got to go further out the risk curve with all your other investments as well. But you got to look at the other side of that trade, right? Like, who's giving them the money? Who's lending them the money? Yeah. And at the same time, when we saw the gilt market blow up, you saw credit default swaps on Credit Suisse go higher than they were in 2008. So I don't have any proof of this, but you kind of have to scratch your head and say, well, wait a minute. Maybe Credit Suisse's balance sheet had exposure to the pension funds that had exposure to the gilt market. And so my point there is, you can sit there and say, oh, these banks' balance sheets are fortified and they're super strong, and there's no risk to the global monetary system or the global economy whatsoever. But you don't understand how much contagion there possibly is and how interconnected all of these balance sheets are. So going back to what you're saying in the credit market, I think that's a huge blind spot. And although the Fed may come in, and I definitely do think they would come in and backstop it if they felt as though there was no bid or there was a lack of liquidity, I don't know that that prevents the second and third effects that are kind of later down the line, right? I don't know that just by backstopping the gilt market, that would prevent a Credit Suisse from going under, because I don't think that the central planners are that coherent. I don't think they understand the systemic risk. I think that they're very reactionary, and they're definitely behind the curve. So the bottom line here is, when you look at the yield curve, going back to the 3-month and the 10-year, this is telling us there are massive, massive problems, not just in the United States, but with the global economy, and I would argue with the global monetary system. And the Fed can come in, or the central banks can come in with these little kind of, as my buddy Adam Taggart says, monetary duct tape, right?
Yeah.
But at the end of the day, that's not going to fix the gaping holes that are, or the gaping cracks that we see forming in the monetary dam right now. And you're going to have an event that I don't even think the Fed's balance sheet can backstop, although I think they'll try. And going back to your point, I think that may be why the prices are just are high to a point where they don't make sense in the junk debt market.
I wanted to jump in, and I was trying to get the 3 and 10-year up there, but we're on the Zoom. One of
I can tell you right off memory if you want me to.
No, I was going to bring the chart up. I was just going to bring the chart up for us. No, I'm sure you. I know they inverted. I had a look at it recently. The second part that I never spat out of that question was, since we last spoke to you, I don't know if you recall, there was a suppressed news item that kind of leaked out and then was killed and wasn't discussed any further. And it was about the Federal Reserve providing around 25 odd trillion to a handful of the biggest banks, of which Credit Suisse and European banks were a handful of the biggest, including Deutsche Bank. Credit Suisse received 2.8 trillion. Like, I'm talking trillion. You're talking about I don't know what Germany's full GDP is as an economy, but I think it's around that ballpark itself. You're talking about unbelievable amounts, and they doled out in total something approaching mid-20s, and it ran on zero hedge, and it featured in 1 or 2 items, and it got killed. The news didn't follow through. This is the single biggest numbers ever. And not only was it US banks, it was also Bank of America, Citi, and a variety of others. But there were also these European banks. And that kind of supports your speculation that you were saying, because you mentioned Credit Suisse specifically, and you said maybe they're the other side of, who's giving the leverage to these British pensioners to try generate the 7% alpha that they need, the 7% return they need to meet their pension requirements. Well, these banks are potentially, and they received a bailout, in essence, bigger than any that has ever occurred. But it wasn't a country, it wasn't a nation state, and it was a flash of news that was cold and it went quiet. Did you see that article, and do you remember? I think it was about 9 months ago. I don't know if you recall that.
No, but I've been following the dollar swap line that the Fed has with the Swiss National Bank. And that was really a big deal about, a month ago or so, where now the last 2 auctions that the Swiss Central Bank has had, they have had no bidders. So just for your audience, what happens is the Swiss National Bank, every Wednesday, they do a dollar auction. And so, and this doesn't necessarily have to be with banks that are just Swiss-based banks, because other banks, like in the UK, HSBC maybe, could be using those banks as a subsidiary, right, to get the dollars they need if they got a real crunch there. But you saw that about a month ago, these auctions, for weeks on end are just zero, 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 zero. And all of a sudden it bounced up to like 3 billion. And then the next week it bounced up to 5 billion. The next week it bounced up to, I believe 11 or I think it was 11 billion with 17 counterparties. Now, to be clear, the last 2 weeks it's been at 0. So it went right back down. But the problem there, and most people say, oh, George, well, who cares about 11 billion? That's peanuts. That's a rounding error. But you don't understand what that implies about the system. That implies that the system is short on dollars. And you say, okay, well, so what? They got the dollars they need. But why is the system short on dollars? The system is short on dollars because the banks believe there's way, way, way too much counterparty risk, or else they'd create the dollars themselves. You see, what most people don't realize is there's really not too much that constrains the bank's balance sheets in the United States, and especially outside the United States in the Eurodollar system. The Eurodollar system creates dollars, and it's cashless and reserveless, right? Now you could argue Basel III and some of these regulations, but I think, again, these banksters, if you will, they're ahead of these regulations. If they want to expand their balance sheet, they can. So there's nothing that prevents them from creating more dollars. But if there's too much counterparty risk, then they're not going to provide that liquidity to the counterparties. So in my opinion, when you see these dollar swap lines being utilized by these other central banks, and you see these big banks, and you don't, so the Swiss bank doesn't disclose which banks came wanting the dollars, right? Because that kind of could be a self-fulfilling prophecy where people think they're in trouble, so they short their stock, etc. But if you look at the uptick, let's say, and although it's gotten back down to zero, that is true. But when you just even see the 3 billion, 5 billion, 11 billion, that tells you, in my opinion, there's a lot more counterparty risk, because those entities can't get the dollars they need because the banking system won't create those dollars for them. You see, people get confused, and they don't understand. They think that there's some sort of limitation on the amount of dollars that circulate outside the United States, or even within the United States. And that's not true, because all the dollars is just a reflection of a bank's balance sheet, really. And it's just entries in a bank's balance sheet, and they can expand that to whatever degree they need. So there's never a shortage of dollars. There's only a shortage of confidence that the bank's going to be paid back.
Yeah.
You see? So when you see those swap lines utilized, my whole point, that, in my opinion, is an indication
of stress.
That the market is saying, hey, there's a lot of counterparty risk out here that you guys are completely ignoring. And although they may have a backstop, the Fed's balance sheet, I don't think that that's a panacea. I do think at some point in time, that's the chickens are going to come home to roost. And what we have to understand too is that whenever you're manipulating an economy through central planning, even if it's the Fed bailing out, long-term capital management, or the banksters in 2008, or what they did in 2020 with the corporate debt market, that's creating more malinvestment and a further misallocation of resources.
Indeed.
So at the end of the day, that's just making things worse, although it's just giving this temporary Band-Aid or monetary duct tape, right? That's not solving the problem. That's just kicking the can down the road. And at some point in time, you're going to have to pay the fiddler. And I don't think the Fed's balance sheet is more powerful than the market. And we could, in the bond market, could be telling us right now that it's predicting that there's going to be this clash between the marketplace and the Fed's balance sheet, or the central bank's balance sheets, coming in 2023, and that the market is going to win that battle.
So in the terms of the yield inversion, it can be 3 to 6, maybe long. If it's long, I don't think it's going to be long. We're going to have a real recession, and I don't think we do normal recessions anymore, especially given how geared and leveraged everything is. How should the people prepare for that? I know you're a big fan, and you're in Colombia, Medellin, and other places. You're a fan of property. Physical assets has been a theme in our stream so far. We'll probably touch on metals. I had a question from one of our community members for George. It was Ben who was asking the question, where best to buy property now around the world, and why? So he's assuming you're still a big fan on real estate, but you might want to talk about the risks and maybe, wealth taxes and other things if you want to do that in various countries. But if someone's positioning for this yield inversion and all the pain that's likely to yield, and wants physical assets, and he's decided real estate is part of that, where's your happiest place for buying for the next 2 or 3 years in property?
So I'm probably going to throw you a curveball here, but I would say 3-month treasuries or 6-month treasuries, T-bills.
You like
so why am I saying?
Yeah, go ahead.
Yeah, because long term, you're absolutely right. I think that we have gone into a commodity super cycle. And usually those commodity super cycles last 10, 15 years. But commodities have really run. And some of my favorites, like coal as an example, have really, really gone parabolic. So, long term, I'd love to increase my position in coal, copper, uranium, etc., but not necessarily at these prices. So I want to keep dry powder on the sideline to take advantage of what I think will most likely be price declines as a result of what we've been talking about and what the yield curve is predicting. Now, I could hold that money in a checking account or whatever, or a savings account, pretty much get 0% interest, and then your counterpart is the bank. But I prefer to put that into like a 6-month treasury and get a 4.5% annualized yield. Now, the pushback is going to be, well, George, you're still not keeping up with the rate of inflation. I get it. Absolutely true. Absolutely true. But I think what could happen if my base case, comes to fruition in 2023, is the Fed will have to, quote unquote, pivot, right? I think the Fed will most likely go back down to 0%. I mean, I say that with a little bit of hesitation, but I think that's the most probable outcome. So if the Fed goes back down to 0%, you have to ask yourself why. What would the market look like to prompt them to make that move? And in that environment, commodity prices are coming down.
Yeah, paper, right? Certainly, yeah.
So
paper, gold, and silver will also be very low again.
What's that? Gold?
Paper, gold, and silver will drop quite extensively if that occurs.
Absolutely, and Bitcoin might as well. But that's an opportunity. So what I'm saying here, and what I'm doing, and this isn't investment advice, but just my own portfolio, I've bought a lot of these T-bills with the idea that there's nothing I want to buy right now, even real estate, because the prices are too high.
Yeah.
So I'm going to go ahead and park my dry powder in T-bills, because when the prices come back down to a level where I think they're quote unquote cheap and where I want to actually start buying them again, that's an environment where I think the Fed drops rates to 0. And if the Fed drops rates to 0, I'm going to have a capital gain
on your bonds,
on those 6-month T-bills. So you go ahead and realize the capital gain on the T-bill, sell it to get the dry powder back, the cash, to go ahead and buy the commodity prices or real estate that has now become a heck of a lot cheaper as a result of whatever the inversion of the 3-month and the 10-year is predicting. So that's what I'm doing in my own personal portfolio. And again, I think people can make their own decisions, but believe it or not, I like the short end of the curve right here for those reasons. So
I think what you're essentially saying is not that you've suddenly become fan long-term of debt, but that in a parking place, for a short holding period until we get this disinflationary force, that these higher interest rates that are still to bite and have a delayed effect on people in the States that have fixed deals that are coming off 2-year discounts or whatever, are only really going to feel the pinch when they have to refi. All of those things still to bite and knocking on. You'll put it in the best parking bay for now for that short term. Yep. So the short term trade is that, but the real interesting trade is there will be a second stage, in our collective opinion, which I support your view, in the commodity bull market, in the world of physical things, where your physical silver, your platinum gold, possibly uranium for energy when we start power up again and we start doing business again and heating houses, etc., etc. Any picks in the commodity play? Because that's the big game. I'm not so sure I'll try to time it. I think you could get better deals on the paper price of silver, but I'm just scared of premiums or change of rules and you get caught. I'm a technical analyst. I love timing markets. It's what I do and all of that. But I think there's so many possible force majeure type events in between that trying to be overly clever on positioning for the long term, even if it means you wear a bit of red during the deflationary spell, could bite you. But That's just a personal preference. I like what you said. You know, you will get a capital gain as well as a real, not a real term yield, but a less negative inflationary yield. Yeah. What are your chosen commodities that you would take, and where would the property purchases be then? Obviously, property prices might correct more in certain areas, so it's a bit hard for you to say. I mean, you might find the States gets really cheap because it's super leveraged, and you know, Nevada and Vegas drops really hard. They often do, in Miami, and that you're getting things for a song. But outside of any real outlier corrections, that real estate is quite broad and generally around the same level for correcting. What do you like now that if it was priced 15, 20% cheaper, you would get?
I like Turkey and Dubai.
Turkey and Dubai.
Property. Yep. I like Turkey and Dubai. I think long term, especially with the BRICS coming together and the world coming to the realization that commodities are far more important than green pieces of paper, that a lot of the power will be going toward those BRIC nations. Whether that's good or bad, I'm not here to say. But in that world, I think Dubai becomes the London, and property prices really scream. I think Turkey plays a big role there as well. I think you could get some good bargains with the hyperinflation.
Can I pay in lira, Turkish lira, please?
Yeah, and I also like the fact that I think if it's 400,000 is the mark right now, where you could potentially get a passport, and that's always good to have as a plan B. Yeah. As far as the commodities, I love coal. I absolutely love coal. I think it's going to be the lead of this super cycle. So I say that because I would suggest all your viewers read Jim Rogers' book, Hot Commodities. Yeah, that's one of my favorites. And he outlines the last super cycle we had. This was written in about 2003 or so. And his favorite commodity at the time was lead. And if you remember back then, lead was public enemy number one. You know, it was getting kids' bloodstreams, and everyone was scraping it off the walls of the paint and everything, and worried about it being in pencils and stuff. Yeah. And no one in their right mind wanted to invest in lead. Very similar to what you hear about coal right now. But he pointed out that regardless of whether people like lead or not, the world is still going to use it in things like car batteries to a significant degree moving forward. So you're going to have zero money going into the supply side, but demand is rather inelastic. And I think that no matter how much these climate people want to talk about it, especially, in fact, the more aggressive they get with these climate change policies, ironically, I think the more demand for coal goes up. Look at what Germany, Germany's using more coal now than they ever have in the past. So now I don't like it at these prices, but long term, it's definitely one of my favorites. Also, I love copper. Yeah, it's just the same story. Copper with this whole green initiative. If they're going to do a Green New Deal, if we're going to electrify everything, and that's going to be the political push, then you're definitely going to want to own copper. I think it's $350 now. If my memory serves me right, when you adjust for inflation, it gets rather cheap, around $250. So that's kind of what I got on the watch list where I'd like to be a buyer. Uranium, love uranium. And I think those are probably, I'm just trying to think through, those are probably my three favorites as of right now. Oh, and then I love gold miners. And I say gold miners, not gold, because gold I don't look at as an investment or a speculation. I only look at it as insurance. I don't think you buy gold to get rich. You just buy gold to stay rich, especially when you consider the capital gains and whatnot. But the gold miners, completely different story. And, I think that if you can get some cheap gold mine, and let's remember too, that if we do have a significant market decline or big recession, usually, especially with the stock market, gold goes down significantly. Yeah. So if you go back to Lehman Brothers as an example, you go to March of 2020 and gold absolutely plummets, but that's also a buying opportunity.
Huge. Yeah.
Huge buying opportunity. And we could see the exact same thing with Bitcoin as well, talking about a speculation.
And silver's the higher beta gold. Silver could fall further as well. Do you still feel the same way as about silver miners as you might about gold, or do you differentiate?
Absolutely.
Yeah. Okay.
No, I differentiate between gold and silver. Silver is more of a speculative asset to me, just because of its industrial use case. Gold to me is like the ultimate insurance policy.
Yeah.
And then silver or silver miners would be more of a speculative asset. Although, if you want to argue for the insurance side of it, I get it. I don't think I would have too much of a problem with that. But just for me personally, gold is like the ultimate insurance, and then silver is more of kind of an industrial metal that I look at as a speculative asset.
So first stock you're buying, you've just heard that, the NASDAQ has plummeted 45%. There's been a debt market event in some critical area. Maybe it's not US, but it could be a first world European nation. All the markets are wetting the bed. It's panic and puke all over the place. You're going straight to which gold ticker to check the symbol price and to get your buys on?
As far as the gold miners?
Yes, of the gold miners. Which is your top? Where are you heading?
I would totally defer to another speaker you have, who's one of my best friends in this space, and my business partner in Rebel Capitalist Pro. His name is Chris McIntosh.
Yeah.
And so, guys,
we'll put it to him
for Chris.
Yeah, it's a
stay tuned for Chris. Yeah, because what I do is I look at all these macro things, but I really don't get into the balance sheets of the individual companies.
Yeah.
If it gets to the point where I'm wanting to pull the trigger based on my 30,000 foot view, I call Chris and say, "Hey, dude, which company should I buy?"
Yeah. No, that's good.
So I think that's the best advice I can give you.
No, very good, very good. I think Rick Rule and Chris McIntosh, you're not going to do too bad with those two's opinion.
That's right. That's right.
And yeah, they'll both be pretty there or thereabouts. But that's interesting. So miners over the metal at the moment on account of relative affordability, because the only thing is they're getting squeezed by the inflation and not getting the increase in price. How much can that continue, or do they eventually hyper perform on account of they eventually have to charge more, or they cease to produce, or where's the triggering event? Because they've actually in percentage terms lagged gold's progress. What's going to cause the trigger? That they just don't dig it up anymore, or they stop selling it at those prices?
No, I think a moonshot in gold. I mean, you see that just the last week or so. I mean, you would know this as a technical guy more than I would, looking at the charts. But gold's gone up by $100?
Yeah,
maybe more than $100. And so that's a significant move, because the market is predicting a Fed pivot. And if the Fed goes back down to zero, let's say, because of a recession, I mean, gold screams. Now, if the Fed goes down to zero as a result of the stock market collapsing, then it's a little different. Gold could tank, but then based on the response of the Fed, and I think the government, then gold will scream as well. So I just see the miners as a leveraged derivative of gold. Now, I want to be super clear here. The way I set up my own personal portfolio, I call it a 10-80-10. So 10% of it is just allocated to insurance.
Yeah.
Like we said, physical gold, pretty much at any price.
Yeah.
Just if I make another $1 million, whatever the price of gold is, I'm putting 100,000 into gold, right? And then 80% things that I call investments. That just means that they pay you to own them. So rental property, obviously positive cash flow, dividend-paying stocks and whatnot. Maybe even some bonds in certain situations. Those would be investments. Now, the other 10% would be speculative assets. Now, that's not a condescending term, in my opinion. That just means that they don't pay you to own them, but there's really great asymmetry. So I would put uranium, I would put the gold miners, I would put them in that category. And right now, I think the gold miners have been beaten up big time. And although, yeah, it is true they've lagged gold, I don't think it's going to be that way forever. And I would be willing to, actually, for me personally, I probably still would wait until we see 2023 play out based on what the yield curve is telling us before I bought the miners, before I took a huge position. But I might nibble right now. And again, the reason I'm a little hesitant in taking a huge position right now is because if we do get a stock market crash, then gold comes down, and that will definitely impact the gold miners.
Yeah. And property, you mentioned yield. So buy-to-let rental stock, are you doing apartments? Are you doing home freestanding homes, which probably yield less but might appreciate more? Are you chasing the yield, or are you chasing the asset and a bit of yield?
I've got a pretty big edge here because I've been a real estate guy since I retired in 2012. So I have a whole team in Medellin, Colombia, that can find really, really good deals. I always say, you know, I'm trying to buy a dollar for 50 cents and then just do some improvements there and get a renter in there at, you know, even with no leverage at a 12% return or so, sometimes even more. But that, you know, not everyone can do that because they haven't built that team. And to be very, very clear, I don't know that I would do that today in Colombia because of the political situation there with Petro. So I am not allocating any more capital. I'm not selling the properties that I have, but I'm not allocating any more capital there just to play it safe. Now, for the average investor, I think just buying a couple rental properties in Dubai or you know, wherever the prices get low, you just got to focus on property management there.
Yeah,
that's going to be your key. I like the single families, especially the starter homes, a little bit better than the multifamily because that's not an investment. That turns into a business, unless you're going to put money into a fund and invest where the fund manager's allocating it and they're a professional. The first person that would come to my mind there would be my good friend Ken McElroy. So that's what Kenny does. You know, he manages about 1.5 billion in apartment complexes, but that's because he's got a huge fund. So the investors give him the money, but that's his business. Yeah. You know, I would not say that he's a real estate investor, that he's got over 100 employees, and that's not passive income. I can tell you that for sure. So you may consider something like that, but and then again, watch Chris McIntosh, because you never know when Chris McIntosh might set up a fund specifically to buy Dubai real estate. Yeah, I don't want to let the cat out of the bag there.
He likes Dubai. I've had him on before, and he was speaking positively of it. I'm a little scared about the harsh, the sort of Arab harsh, the weather and some of the law and the employment law and things that go down there. But I admit that they've done incredibly well. They did have a bad crash last time with their boom and bust. And I think Qatar's probably was the big money that maybe bailed them a little bit. But yeah, it seems there's a lot going on in the Middle East. You know, the Belt and Road system, it's all ends kind of coming in there. There's the Saudi. What's your take on the line that the Saudis are doing? That strip about 300 meters wide, that's literally desert real estate converted into... It feels very much like this dystopian 6G AirPod...
You know, I saw that just briefly on the news the other day, but I've been traveling over the last week and a half, so I haven't had the time to actually look into it. So I don't have an opinion, but it definitely is a little bizarre. That's for sure.
Yeah, it's a whiff of Neom, if you followed that one as well. Sort of this super new city that's going to be this almost this not falling part of Saudi, but without having, you know, the Islamic law and all of those things. And it just does feel like this new high density, cluster them in, pack them in tight. Sell them something shiny and new, but pretty well gridded out with surveillance, I'd imagine. Anyway, I don't want to get too dystopian. What's your big prediction? The Great Awakening. What did you find this year, George, that you really opened your eyes to, that you didn't feel the sense of? I mean, to me, it's been about debt markets. It's all about understanding debt markets. We spoke about credit markets. People have all got to suddenly... The market I'm watching most is that 10-year US. Now, I never used to watch it so religiously. There's been a bit of awakening of the end of debt cycle possibilities and all of that. What's been, since we last spoke, like over a course of a year, let's say, the big awakening for you? And what do you think has been the awakening for others in terms of the retail people you see? And also maybe look forward and say what's going to come at us that we're all going to have to get wise to. So 3 parts to that.
Well, I'd start with the awakening for others. I think that the biggest awakening that I have seen is people opening up their eyes to the true intentions and objectives of the global elite. World Economic Forum, IMF, UN, and how the influence they have over corporations and politicians such as Trudeau is something we all need to be concerned with and we need to push back against. As far as my own personal epiphany that I've had in the last year that has really impacted my thinking for the future, it would probably be the collapse of the American empire as a result of the United States dollar. So most people think that the dollar is going to crash to zero, and that's, takes the United States down with it. I actually think it's the opposite. And that I would agree with my good friend Brent Johnson here, that the dollar, now this doesn't mean to say that we don't have consumer price inflation in the United States. I think that this is going to overall be an inflationary decade in the US. But it is to say that the dollar is going, in my opinion, most likely continue to be a wrecking ball for these other economies. And you say, well, George, how does that bring the United States down? That's good for the United States, right? It's just like World War II, we're the last man standing. But here's, I think, most people's blind spot. Number one, it's the dollar going up instead of down. And then number two, it's people have to realize that we were a huge beneficiary of being the last man standing after World War II, but we produced far more than we consumed back then. Yeah. Now we consume far more than we produce. So I would use the fall of Egypt as an example. So this was back around 1175. They had a pharaoh there named Ramses III. And Ramses III had a real battle on his hand with this group called the Sea Peoples, which sounds like something out of science fiction, but it was actually a group, and they completely decimated pretty much every single city, town, civilization, empire that they came across. And they wouldn't just steal the gold and whatnot. They would just burn the whole city. I mean, straight to the ground. And what happened is Ramses III knew that the Sea People were basically coming for him next. And so he set up all these traps for around the Nile River Delta because he knew their ships would be coming in. Long story short, Ramses defeated the Sea People. And this at the time was like the #1 threat to humanity. And so all the Egyptians celebrate. Ramses III is patting himself on the back. Great, nothing to worry about. We've defeated our biggest foe. We've saved the world. Let's move on. Within decades, the Egyptian empire had collapsed. Why? Because, like the United States today, Egypt was very dependent upon imports. Now, they did make a few things, but their entire economy depended on the, let's say, tin they were getting from XYZ area, or the copper they were importing from Cyprus. So even though Egypt was the last man standing, they still crumbled. They still fell. They still collapsed because all their trading partners were wiped out.
Correct.
And if you think about the dollar and what it's doing today, it's effectively doing the exact same thing the Sea People did, is they're wiping out, or the dollar, ironically, right? Because it's supposed to be our greatest asset. It could be our greatest liability in the sense that it's wiping out all of our trading partners. I mean, look at what it did to Sri Lanka. Look at what it's doing to Turkey. Look at what it's doing to potentially Europe, to the UK, to the gilt market. Why you don't think the dollar had anything to do with that? Right? And so you look at how much dollar-denominated debt is we have globally, and how much demand, and if the global economy slows down, it makes it harder to service that debt. You could easily see the DXY go from 110 to 130, 140, 150, who knows, to where, yes, the United States will be the last man standing, but it will ironically, it will collapse our entire economy because we can't get those goods that we need for Walmart, Target, Home Depot, because we're completely dependent upon all of these other economies that the dollar is in the process of destroying. So then I think you get a Plaza Accord 2.0, and they try to artificially bring the dollar down, and that's when I think you get the dollar collapse. But ironically, I think the dollar collapse will be a result of the dollar actually going up, not down to begin with. So that's kind of the big epiphany that I've had over the last year, that maybe people can find some value in.
No, it's very good, and I agree, and I concur, and we're milkshake theorists on that one as well. We see a super spike, and we see it's a bit like, as you say, cutting down the ladder you're standing on when you destroy the other nations. And I also see Jay having to run in front of this avalanche. So he's got to keep tightening and being one of the hardest hawks, even in spite of a slightly reducing inflation rate. So we go into a debt-based event. It's going to be very, very interesting. Thank you so much for sharing your wisdom, George. We always appreciate having you. Can I give you an opportunity to tell people how they can engage with the rebel capitalist?
Yeah, anyone could just look me up on YouTube. It's just George Gammon, Gammon, and my main channel will come up where I do the whiteboards. The Rebel Capitalist channel will come up, and I'd say you can follow me on Twitter. But what's bizarre is I've actually been locked out of Twitter since Saturday.
Wow,
it's going on almost a week now that I can't access my account. So I don't think I'm banned or anything. I've sent them probably 3 emails and a couple appeals, but I've yet to hear back from them. And a lot of my subscribers and whatnot have gone to Twitter and said, hey, they mentioned Twitter support and told them about the problem. But as of now, I cannot access my Twitter account. So anyway, might not want to follow me on Twitter right now. Might want to focus on YouTube.
You must have insulted elongated muskiness, George. Anyway, I'm sure they'll have you back. They can't live without you. None of us can. George Gammon, thank you so much for coming onto the show and being part of our stream. We'll catch you again soon. And we're straight on to Chris. Thank you so much. Have a great day and weekend. Bye-bye.